Should you refinance your mortgage? Given where interest rates are, it seems like everybody's talking about it. But is it the right financial decision for you? In today's podcast, we review a thoughtful approach that you should use if you're considering refinancing your mortgage. Hello, this is Andrew Busa, and I'm a financial planner here at Advisor Investments. We're here with another Advisor You Can Talk To podcast. And today I'm joined by my colleagues, Dina, Milne, and Rick Winters. They each manage client relationships here at Advisor Investments.
Hey, Andrew.
Hey, Andrew and Rick.
Great to have you both on today's episode. So, today we're going to give you 5 questions to consider when thinking about refinancing. So, when interest rates drop, this immediately becomes a hot topic on news outlets and personal finance websites. And you're probably seeing advertisements to trade in your old interest rate for a new one. But we'll find out today that there's more nuance to it, right? So, Dina, what are some of the reasons you're seeing as to why people are looking to refinance?
Yeah, there are really three main reasons why people refinance. The first one is lower interest rates, and you already mentioned that. Whenever the rates drop, this is a great opportunity to get a cheaper loan. When you initially set up that mortgage, your rate might have been, a couple of percentage points higher, and so the lower rate is definitely going to, give you better cash flow and give you a lot of advantages. A second reason is, with a lower interest rate, you get a lower payment. So, as I mentioned before, you've got better cash flow. You can redirect cash to, if you want to save it, if there is a project that that you want to put money into, that's definitely going to be a great advantage. And then the third point is a lot of people like to use the equity in their home to finance other projects. So, for example, if you want to do a renovation, renovations are fairly expensive, especially if you're doing a kitchen or a bathroom. So if you've got equity in your home and you've already paid down a lot of your mortgage, you can actually use that equity to finance that renovation. Many people also who have kids, that are going to college and they want to help them out with their tuition, they can also use that equity in their home by refinancing and using that extra cash flow to pay for tuition and other big expenses that they want to pay for.
Yeah, so really starting to see why refinancing can be such a powerful financial tool. Before we dive into the 5 questions, Rick, I want to tip it over to you to just unpack some advanced terminology that'll really help us lay the groundwork for today's episode.
Yeah, so I think it was important to just kind of highlight a couple words that you may hear and just give you some general meaning. Um, we're not going to be able to pull them all apart today, but just want to make sure that, as you hear some of these things, you may want to look into them and understand a little bit better. One is, the terminology of points.
Hmm.
What is that? It's, mortgage points or fees just paid directly to the lender at a closing in exchange for, a reduced interest rate.
Hmm.
um, that sometimes is required. Closing and settlement costs, that's just associated with the completion of a sale or purchase of real estate.
Hmm.
You're going to have that when you're sitting down signing the papers. You're going to have to pay some money. Taxes, property taxes.
Hmm.
Depending on where you live, they may be more or less. Insurance, your property, your mortgage company is going to want you to have insurance. You're going to want to have it as well. And then interest rates. Well, when we talk about interest rates, which will come up a lot today, where there's the difference between a fixed rate mortgage and variable rate mortgages
Hmm.
and higher or lower interest rates. And then the mortgage term, which will affect all of these things: 15 years, 20 years, 30 years. So as you hear these, just understand that there's maybe more that you'll need to look into, but just to give you a quick starting point to work from.
Yeah, that's a great foundation. And one more caveat to throw in here: this podcast is geared towards primary residence refinancing. So some of these concepts might apply to an investment property or a vacation home, but the considerations for those are going to be a little bit different. So just keep that in mind. This is primarily geared towards the primary residence. So without further ado, let's dive into these 5 questions to consider before refinancing. And the first two really play off of each other, and you'll see that. Number one is, what are the fees? Dina, I'll let you take this one away.
Absolutely. So, as you know, nothing in life is free. So, when you're going through a refinance process, it's basically like applying for a mortgage from scratch. It's going through the process all over again. So, any costs that you remember, having to cover when you initially set up that mortgage, like your titling fees, appraisal, any kind of legal fees, closing fees, there are fees to this process. The
Lots of
lender or
fees.
Lots of fees. The lender or the bank will be very clear. They'll break it down and they'll give you a breakdown of these fees. They could be, as low as 3,000 to, much higher than that. The nice thing is that many lenders can wrap this fee into the new mortgage balance. So you don't actually have to pay it out of pocket. They'll just add it to the mortgage balance. But remember that by adding it to the balance, you're paying interest on that. And the other option is you can pay the closing fees, out of pocket. I think the important thing to consider, though, when you are doing a refinance is what these fees are. So let's imagine, for instance, that you're paying, $3,000 in closing fees, and then your new mortgage payment under the refinance is saving you about $200 a month. And so, you would probably make up this cost, the $3,000 that you paid to refinance, you'd make it up in a little over a year. So that could be a worthwhile process.
Yeah, that's definitely part of the calculation as you kind of think out of like making this transition. It's trying to improve something or
Mhm.
give you access to some money. So as you think about some of these upfront costs, there is a recovery period. When do you actually break even?
Right. And ultimately, what we're talking about here with refinancing, you're trading in your old mortgage for a new one.
Hmm.
So, to your point, Rick and Dina, you're not going to want to do this unless it helps you financially. I also want to throw in with this question here, know the difference between the contract rate and the APR, right? Because the APR is actually what you're going to be paying, the annual percentage rate. What's advertised, that could be a different story. So when you're talking about fees, that's really what you're going to be focused on. What's your APR, right?
Yeah, so that kind of goes back to knowing the terminology. We can't
Mm,
fully pull that apart for
right.
each person and your unique situation, but it is, yeah, you just read the fine print,
Absolutely.
take some time. This is one of the biggest transactions that you'll ever make in your lifetime, maybe many times in your lifetime if
Hmm.
you're moving and making different purchases or refinancing like we're talking about today. So take some time to get to know the terminology and really pull apart those costs. They're okay. This is,
Hmm.
people don't do things for free. You're going to have to pay for the services you're receiving. So we don't want to make it sound like it's a daunting thing. Just know that when you get down to signing the papers, there's costs for each one of those signatures you write that day.
Right.
Hmm.
So, when it comes to recouping those costs over time, Dina, you already touched on a little bit. This is a good transition into the second question to consider, and that's going to help you consider what your break even is. So, number two is how long are you planning on staying in your current home?
This is one of my favorite topics because it's asking you to look far into the future.
Hmm.
Since many times we're talking about 15 or 30-year mortgages here, and tell me exactly what's going to happen.
Right.
That's almost impossible.
The crystal ball.
Yeah, the crystal ball. So, one of the examples is as people are transitioning through many different stages of their life. One example that I think I can start with here, because this is where most people are walking into their first house, is that you've made your first purchase. It's just you and your partner, your wife. Or your spouse, and you're making your first purchase, and you've got all these plans of all these things that could happen, but you can't afford the biggest house you're ever going to own yet. So you buy your house, you know that you're going to have to transition. And a couple years in, everybody's sitting here saying, it's time to refinance, and you're thinking, well, I'm probably going to move in the next year or two because we're going to have maybe we're going to start a family, might have some kids. Or we're just trying to look to expand. Am I in a position to refinance if I'm just about to look at making a move in the next year or two? Probably not. I mean, as you do have to take a moment to stop and think about what's about to happen. Just because interest rates are lower and it sounds like I can lower my payment, if I don't give myself enough time, I can't hit that break even. And I think, Dina, you have an example for, later in life, even maybe more
Yeah.
relevant.
Absolutely. So this is kind of the other side of your story. You're working with the first time home buyers. Now I'll be talking about people who have their kids have moved out. They've finished paying for college. They're considering retirement and possibly considering either downsizing or moving to a different state, a warmer state possibly, and they're not going to be in that home for a long time. Again, you don't know exactly what that timeline is going to be, but it might not make sense to go through this process, pay those fees, and then not be there long enough to break even and recuperate that cost.
Yeah, so I think people are oftentimes trying to look for like a rule of thumb here. And if I was to give just some general guidelines, is if you're going to be somewhere less than 5 years or 5 years, it's probably not a good opportunity for you to refinance. If you're going to be there for 10 years, it might be. If you're going to be there for 20 years, it probably is,
Right.
without a doubt.
And
So,
that's also going to depend too on, again, how low can you get your rate? That's obviously plays into your break even. And if Rick, like you said, if you're planning on moving in the short to midterm, you're going to have to kind of take a hard look at the how much you're saving and how long you're going to be staying.
hey, you're cheating. You're jumping ahead to other questions.
Yeah, sorry about that. I couldn't wait. I couldn't wait.
But you're absolutely right.
Well, on that note, let's move ahead here. So, number three, also very important here. Consider what will it take to qualify for this new mortgage.
Yeah, so this is Andrew. This is a full credit application. So
Right.
you're now going through a credit application. You're going to have to provide a proof of income, possibly tax returns, statements, potentially to show that you've got liquidity and net worth.
Hmm.
It's a full credit application, credit check, and you have to consider where you were when you purchased the home. Your situation might have been a little different. You might not have had some car loans or other debt
Right.
reflected on your credit. You might also be in a position where you're retired and you don't have that traditional source of income coming in, and so you'd have to prove that you've got cash flow coming in order to qualify for this very kind of in-depth application
Mhm.
process.
Yep, absolutely. And maybe a good example is a lot of times we're working with folks in retirement, who, think about it, their paychecks don't show up each month. They
Mhm.
get
Hmm.
Social Security, and maybe they're in a fortunate position where they're now able to exclusively live off their investments and maybe some other smaller fixed income. Well, when you go to the bank and say, "Hey, I want to refinance my house," and yes, people in retirement can absolutely have mortgages, by the way, in case anybody was wondering, just because you're retired, especially with interest rates as low as they have been compared to historical rates, yes, it is okay to be in retirement with a mortgage. So when we're talking to that person that wants to refinance, and is still debating in retirement whether it should be 15 or 30 years,
Mhm.
um, we want to be able to help them qualify. So when they go to the bank, the first things they want to see is where's the money coming from. So
Mhm.
sometimes we have to create that cash flow, to show that you have a consistent deposit. And that's just being part of that process to be able to qualify. So sometimes you have to do some advanced thinking before you go to knocking on the door at the bank and saying, "Hey, can you loan me a couple $100,000 when I don't have any cash flow showing in my checking account?"
Yeah.
Well, and even when your mortgage is staying at the same bank, you still need to requalify. So just because you're staying with
Yeah.
the same provider, you're starting from scratch. To your guys'
Hmm.
point.
Yep.
Yeah, and I think it's important to mention here too that the lender that you choose to go with is also really important. So
Yes.
if your situation is very straightforward, very simple, you're still working, you've got income, you could probably go with any lender. But if you're in that situation, as Rick mentioned, it's a little more unique. It needs to be a little more personalized approach. You might want to consider, going more to kind of a relationship based bank, somebody that you already know. It could be, a credit union. You might be a little more limited with who you can find, that financing through.
Sure. Yeah, and we'll touch on that whole concept a little bit later in the episode as well as another consideration, but definitely something good to consider there. Uh,
Mhm.
so number four, Rick, I know this one is near and dear to
Hmm.
your heart.
Yes.
That is, what term should you opt for?
I think Dina and I we come from slightly different viewpoints on this, and that actually makes our conversations more fun. Is that um, when you're thinking about a 30-year or a 15-year, which are traditionally the two time frames, you can absolutely get different time frames than that, but let's just
Mm-hmm.
use those to kind of unpack this concept. Well, besides the time that it would take for you to pay down this mortgage, it also comes with some other differences, which is include cost and interest rates.
Mm-hmm.
Now, think about if I'm borrowing money from a financial institution, if I borrow it for 15 years, I create less risk for them with the idea that I'm going to be able to pay it back faster.
Right.
So that usually comes with a lower interest rate. So you may be looking at the difference on a 15 of 3% versus a 30 of 3.5%. Well, right there off the bat, I say 3% is better. I want to pay less. Well, with that time frame difference, even though the interest rate's lower, I have a higher monthly payment,
Mm-hmm.
which requires me on a month in and month out basis to make that payment, including any of the other wrap-ins that I have with it, like insurance and or taxes. Um, and over time, that can be difficult, especially if we hit some speed bumps in our planning. So the 30 year, as we think about it, yes, it will over its lifetime cost us some more in interest. But if we look at the monthly payment, it'd be less and may actually afford us to be able to do some other things with that money. Now, as long as I don't take that extra money on the 30 year that I'm not paying because I've got this longer time frame to pay it, and so my monthly payment is less, and I don't take it and go on vacation each year,
Mm-hmm.
or buy the newer and more expensive car, but I actually turn around and I save it.
Mm-hmm.
There's one thing that you do get as an advantage, potential advantage with a 30 year, especially since yep, the mortgage may be over 30 years, but the good thing is that I actually have been saving on the side and I have this big investment account
Mm-hmm.
that now is compounding and continuing to grow over my lifetime, which last I checked, no matter how hard or how much I dug around the house, I can't uncover the cash that I've buried in my house. So it's
Mm-hmm.
sometimes nice to make sure that I have some cash on the side invested in a side account so that I can make sure that I can make that monthly mortgage payment while I have it.
So, this question really gets to the heart of the fact that there's some investment implications as well with what term you opt for. Rick, you talk about, interest rate versus maybe what you could get investing that money instead, right?
Yeah, I mean the investing part of it is if you're gonna be someone who takes your extra money because remember if I'm paying $2,000 a month on my 15-year mortgage and paying
Hmm.
$1,500 a month on my 30-year mortgage and I take the extra 500 that I have each month and invest that and I earn, I put it in cash. Well, I'm not going to be able to keep up with my 3.5% interest rate, but if I invest it in my investment account for longer term appreciation, I'm able to earn, I don't know, 3.6%, or maybe even way better, let's say 6%, or
Hmm.
we're really aggressive and everything goes well in the world and we're at 10% annualized. Obviously, the bigger return we get, the better outcome. But I would always argue, and Dina, this is where you and I
Mhm.
may have some pushback or a different thought, is I'm very comfortable leveraging myself on my house because I know I just have a monthly payment. So I can use that extra money to invest. But on the flip side of that is I've put very little into my house. So when I look at what my house represents for me, I have put in, let's say, 25 or 30% of the house value. But when the house value goes up 10%, I don't only get it on what I've put it in, I get it on the actual house value.
Hmm.
Mhm.
So let's say just as a quick example, I think this will help it hit home a little bit more. Is that if I have a $500,000 house and I have $100,000 in it, and the house value goes up 10%, well, I'm now have a $550,000 house that I only had $100,000 in. I just made $100,000 on my $50,000 investment while I had the ability to save over on the side. Now, this is for fortunate people. This is for people who have enough cash flow to meet these obligations and
Hmm.
still do the thing that most people would love to do, and that's save in addition. So I know this is a perfect scenario that I'm talking about, but don't miss it. Don't think that like my goal is to always pay off my loans immediately
Right.
when I've got access
Right,
to these low loans. And if you are lucky enough, you may even be able to deduct this interest on your mortgage. Tax laws are
right.
unique to each person, but anyway, Dina, go ahead, please.
Yeah, so I think Rick, the reason why we have maybe different perspectives on this. I mean, I agree with everything you're saying. However, I think debt is a psychological concept,
For sure.
and for some people, they're very comfortable, kind of looking at it the same way that you are, that they're leveraging, that real estate, and they're building up, their investment accounts at the same time, while other people are not comfortable with debt and the objective is to get it paid off as fast as possible.
Hmm.
And that can sometimes cloud the the idea of also trying to balance out other investment opportunities. So from my perspective, it is a balancing act,
Hmm.
and you can get the best of both worlds if you just balance it out properly. So in a situation like this where somebody did refinance and decided to take the 30-year term, which is I think what we would all recommend. It gives a lot more flexibility. If they do have excess cash flow, like let's say they got a bonus or they got an inheritance, I mean, I don't think that it's unwise to put a little bit of that towards the mortgage. It just pays it off a little bit faster. But you also have to balance and make sure that you are building, your retirement savings, you are setting money aside for any other, goals that you might have, and not just putting it all, into the mortgage.
Right. And this is where the art and science part of this comes in. You can run the numbers on a spreadsheet and it might turn out that, the 30-year looks better,
My spreadsheets
right?
always show that investing is better.
They do. I've seen them. Um, but Dina, like you said, debt is a psychological concept, and some folks are just more comfortable getting this paid off as soon as possible. There's no one right answer. That's why it's personal finance. We're going to help you think through it for your individual situation.
Hmm.
So that's a really good one, guys. I think let's transition to the final question, number 5. At this point, you've gone through the first 4 questions. Let's say you've decided you want to go ahead and refinance your mortgage. You've got your rate, the fees, your break even, what term you want. Okay, now the rubber's going to meet the road. How do you complete the refinance process?
Yes. So, I, where I'm going to start off with this is now now I go to this bank, this imaginary bank that we've been talking about, and I'm going
Hmm.
to ask for money. Well, what does that actually mean? People think of their bank, they may think of the big national bank that they've been using for the last 20 years, but in many cases it's not. It's
Hmm.
you have to think. Well, let's here. I'll pinpoint it down to there are those big national banks, but you're probably going to be better served maybe contacting that regional bank that's a little bit
Hmm.
closer to home first, who has a vested interest in the community and the place that you live. Another option would be to consider going online. Use your junky email account to contact these companies to make sure that after you get, you find out your initial contact on what's going to be in it for your potential loan or for your refinance mortgage, um, that you can survive the bombardment of
Hmm.
advertisements that you get afterwards. That is a fair warning. The other one is if you're in a fortunate situation where you have quite a bit of financial resources, um, you may be looking at some of the private banks or private client services, which could give you access to some of these better loans. It's really going to be unique to you, but don't just take the first offer, I think is my biggest point.
Yep.
You should shop around. And I mean, if you don't know who to talk to as well, please do contact your advisor. We have a lot of contacts and, we've worked with them directly too. So don't hesitate to reach out.
Yep.
Yeah, that's a very good point, Dina. I mean, and really, if we didn't say it enough throughout this, is that each one of these decisions and each one of these questions that we've gone over are the conversations that we're having with our clients. So don't go
Hmm.
this alone. Take the time to build up your checklist of questions that you need to be asking with your advisor. with us. This
Sure.
is what we're doing here at Advisor Investments, working with our clients.
Yep. It's just like the song says, you better shop around. Let's just let's just say that. All right, so I'm going to recap the 5 questions because I think this is important to do that at this point. So again, number one, what are the fees? Number two, how long are you staying or planning on staying in your current home? Number three, what will it take to qualify for this new mortgage? Number four, what term are you going to opt for? And finally, how do you execute this? So, uh, you know, these probably aren't exhaustive. There are other things to consider, but we think that these were really the 5 most important questions to consider when thinking about whether refinancing is a good decision for you. So, let's wrap it up here. This has been a really great conversation. I know we've wanted to do this one, and I'm glad that we did. It's been on the minds of a lot of people out there. So, before we take it away, Rick and Dina, what were some of your big takeaways from the conversation?
Dina, please, you first.
Yeah, thank you. I mean, I think every person's situation is unique. Every individual, they're coming from a different place. So I think the important thing is to do the research, look at your needs, ask yourself these 5 questions, make sure that it's suitable for you, and then if it is, then go for it. Don't overthink it after that.
Mm,
But I think the biggest thing is make sure that you are saving by going through the refinance process. There's a beneficial savings
yep.
that's going on.
Yeah, I would agree with you. I think that is definitely one of my biggest takeaways as well. And the other is don't, I already said it, but don't go it alone.
Hmm.
Use your resources. You should have someone that you can speak with, an unbiased resource that can get you in contact with the right folks that can help you with the refinancing process. And also, maybe more importantly, fit it into your plan. Understand how these changes will impact decisions that you get to make or maybe don't get to make in the future. Ideally, it would be the ones that you get to make. So
Yes.
let's use your planning opportunity to make that happen.
Yeah, and I would just say, I mentioned it at the beginning, but just because your neighbor refinanced doesn't mean it's the best decision for you. We talk about that with investing, with a whole slate of different financial planning topics. So make sure to talk to us, your advisor, Rick, like you said. So just make sure that it's the best decision for you moving forward. So this has been Rick Winters, Dina Milne, and Andrew Busa from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe, review our show, and you can always check us out at www.advisorinvestments.com/podcasts. Your feedback really is always welcome. If you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Thanks for listening.